Welcome, everyone, to our educational web series. I'm Tim Ressler, and joining me here today is my colleague Vincenzo Palmerino, who is also a member of the financial planning team here at CCR Wealth Management. Today, we will discuss mortgage psychology and how to best allocate resources when purchasing a home. Vinny, thank you for taking the time to be with us today.
My pleasure.
Can you kick off our conversation by bringing us up to speed with the current interest rate environment and expected changes ahead?
Certainly. As many of you know, the Federal Reserve just hiked rates by 50 basis points a couple weeks back. We're expecting them to raise rates several more times this year, and as such, more clients have been calling in with questions regarding home purchases and whether it makes sense to take out a mortgage sooner rather than later, given the expectation that rates will continue to rise. Typically, as advisors, we view mortgages as good debt opportunities, as they not only allow you to have more liquidity since you're not purchasing your home with cash, but they also give you the opportunity to invest those funds for a potentially higher return than the interest on your mortgage, thus creating an arbitrage opportunity.
That does make sense, and I would agree, especially in low interest rate environments that we have been in the better part of the last decade. What would you say to those individuals that are approaching retirement and want to simplify their lives and reduce their liabilities by potentially paying off their mortgage?
So most mortgages allow the borrower to make principal payments without penalty, effectively reducing the length of your mortgage along with the total interest paid. That being said, in an environment like we are in today, low but rising rates and higher inflation, people are actually better off to not prepay their mortgage and allocate those funds to an investment portfolio that's designed to keep pace with inflation.
Okay, I agree, although it does seem backwards to conventional thinking that one should pay off their debt as soon as possible. On the flip side, what would you say, Vinny, to those individuals who are just getting started and looking to purchase their first home while also paying down their student loans?
So while we understand that student loans may hinder an individual's ability to acquire a mortgage, especially with student loan interest rates being higher than most conventional mortgages. That being said, there are ways individuals can put themselves in a better position by refinancing their student loans at a lower rate, reducing total interest that may be due over the life of the loan, and also improving their debt to income ratio that is used by lenders to determine the creditworthiness of the borrower. Additionally, as your credit score plays a crucial role in your mortgage application, you could look to lower your credit utilization rate, which effectively is how much of your total available credit you are utilizing. Keep paid accounts open. I know it doesn't seem like the normal thing to do, but the length of your credit history does matter. So you're better off not closing unused credit cards and avoiding new credit lines at the same time. You don't want to apply for a new loan or a credit card while you're also applying for a mortgage, as it can negatively affect your credit score due to the hard credit inquiries.
Yes, certainly want to avoid those hard credit inquiries while going through a mortgage. And those are great strategies for first-time homebuyers, many of which still have student debt. What would you say to individuals who are at the point in their lives where they are looking to purchase a second home and can afford to purchase this home with cash?
So my knee-jerk reaction is to borrow as much as you can for as long as you can at the lowest interest rate possible, leaving the rest of your funds invested to keep pace with inflation, as we are still in a relatively low interest rate environment. This will give you the ability to pay off your mortgage as quickly as you may prefer, while also having the flexibility of using those funds in a way that you otherwise wouldn't have been able to with having them being tied up in an illiquid asset such as real estate.
Good point, especially given there is no crystal ball and we cannot predict the next 2008. Tying up all of your assets in real estate is a dangerous proposition, and the liquidity and flexibility of funds is very important. I appreciate you walking us through this complex and often misunderstood topic, Vinny. I hope our viewers found this beneficial, as the housing market has been extremely active since the spring of 2020, and interest rates have been rising slowly, and we expect them to continue to rise through this year, next year, and possibly beyond.
Yeah, well, it's been my pleasure here, Tim. And as always, feel free to reach out to your CCR financial advisor, who'd be more than happy to walk you through the situation that may be best for your personal financial situation.